everyone. Thank you for coming out. It's my pleasure to introduce you guys tonight, the founder and CEO of SWAN Capital. Please, everyone, put your hands together for Andrew McNair.
I'm so excited to be with you today to go over the halftime report for 2023. And with the halftime report for 2023, it's such a great time to look at what we spoke about in the beginning of the year in January at the State of the Market. So I'm very excited to share with you our insights. We have a very packed agenda. I'm sure many of you have questions about what's going on in the economy. And I just want to get some formalities out of the way. When we're ever in a group setting, again, none of this is personal financial advice to you. Your situation is unique to the person even next to you. It's that unique. So I do want you to write down all of your questions because I don't want to leave one question unanswered. Now, if we can't answer it in a group setting or you don't feel comfortable, be sure to write that down, send that to the office, and we will make sure we get that answered on a one-on-one review or via email, or just pick up the phone and give you a call to answer it. But if you have a question tonight, I bet someone else has the same question. So that's why we gave many of you a pen and a paper to write those questions down so we can cover that in the Q&A section today. So our agenda is fairly straightforward. We're going to talk about what happened so far in the last 7 months in the stock market and in the economy. We're going to talk about what factors drove that performance, why it occurred. We're also going to talk about where potentially we're headed. I'm going to pull out my crystal ball, which gets a little fuzzy after a day or so, but I'm going to give you what I think we're going to finish out with the year and what we're keeping our eye on here at SWAN Capital. And then lastly, I think this is what you definitely want to know as a client is what are we doing about it? How are we trying to take advantage of these market cycles? So let's begin. How has the market performed? Mr. Market, as I like to refer to it often, is a manic, depressive, and very highly stubborn institution. And this Mr. Market had a very big surprise for all the analysts, all the media pundits. And as I like to joke that, the media pundits, the news has predicted about 16 recessions, but about only 3 have transpired. And so we've been hearing about this recession that we're in or is coming, and the market has had deaf ears the entire time, not wanting to pay attention to all of the news that's happened. And we'll begin with what happened right around March. In March, we had plenty of geopolitical tensions with the Ukraine situation, but then we have Chinese spy balloons flying over our country. We got UFOs, we got geopolitical tensions, and the market continues to keep on going higher and higher. Now, we started hearing some rumblings about the financial sector, and that's where you see SVB, the third largest bank failure, the largest bank failure since the financial crisis. And that was, again, putting the market on pause because we were all kind of with bated breath, chewing on our fingernails saying, is this a bank contagion? Now, as the weeks came, we really figured it out that it was a social media bank run because many of the social media elites had their deposits in SVB and some politicians. It got a lot of noise and attention. And of course, FDIC showed up on the scene with unprecedented support, which if you heard my monthly market recap, I was very against because it sets an unhealthy precedent that the FDIC will always come in to save the day, no matter the cost. And then many small community banks were fearing that, well, will you support us if we're not as big and don't have some of these social media elites with their deposits at our community bank in the state of Omaha, for example? Well, fast forward a few weeks later, and then we have another bank failure with the First Republic. And that pushed SVB up as still one of the largest bank failures right behind it with First Republic. But FDIC decided to take a different course of action and have JP Morgan and auction off these assets for a large institution like JP Morgan to buy up those assets. Again, trying to shrink any bank runs, contagions that we did not want to see and would not be healthy for the economy. But I will say this. Here's why I think it's so dangerous for the FDIC to set a precedence like this. Again, these are the greatest financial minds that are supposed to run these banks. And we saw that interest rates were at super low levels. Again, we're rewriting textbooks right now because of negative interest rates and the low interest rates that we experienced over the last 3 or 4 years. And these bank officials did not, I guess, assume that interest rates would ever go up. So they're locking money in at 30 years, 15 years at very low interest rates. And then the Fed turns direction and finally starts raising interest rates, which we've talked about at many of these meetings, how the Fed has been late to raise interest rates. So again, I don't have a lot of patience or a lot of sympathy for these banks that made those long-term promises at those low interest rates and now want to be bailed out. Next, we had the debt ceiling discussion. I mean, we had this two-party system here in this country where it looks like it needs marriage counseling. They can't decide if they need to raise the credit card limit, even though they're spending more than they make, even though they're in debt to their eyeballs. They keep on kicking the can to the future. But at the strike of midnight, of course, because they want to keep their jobs, they decide they're going to kick the can to a future date and time. But the market continues. It shrugs it all off. And then we see the Fed, which I think made the right decision to pause interest rate hikes, only till July, deciding to slightly raise them. So a lot happened. But as you can see, the stock market went up 15% despite all of those things happening. So it is fascinating. I'm going to talk about what we discussed in 2023 January about what estimates were portraying the S&P 500 was supposed to end this year, and we've, again, surpassed it dramatically. But growth hasn't been uniform. And this is a very complicated slide, but I'm going to break it down for you. If we're looking at investment style and we're looking at the capitalization of these companies, large companies, medium-sized companies, small companies, the growth has not been equally distributed. And you can see this in the top left quadrant right here, where value has not kept up with growth. It is lagging behind growth. And a lot of people, because of institutional money managers, have pushed clients to large cap growth companies, which is a self-fulfilling prophecy because they're pushing the growth and everyone is jumping on the back of that growth, that bandwagon. And so you can see that historically small companies and medium-sized companies have actually done a good job of adding diversification but keeping pace with large cap. But in the last 10 years, it's been a little bit slow and not uniform and not this, equally spread out. And I'm going to talk about our portfolios. We still want to have exposure to large, medium, and small. Now you can see year to date, and we're going to talk about, again, the portfolio changes we've made. Look how uneven and imbalanced this growth has been just year to date, with large cap value going up what appears to be 5% and large cap growth up 29%. And we're going to talk about how we tried to take advantage of that in the rebalancing as well as the shifts that we've made with the portfolios. But this is something we're keeping a close eye on. So I want to give you another visual I think that's very helpful, is why this growth has not been so uniform. If you were to pull out your cell phone today, 57%, nearly 58% of everyone's phone is an Apple iPhone. But it's weird how the Federal Trade Commission seems to be silent, because if you have over 50% market share, we used to call that a monopoly. But for some reason, we're turning a blind eye to these tech companies, which now represent 26% of the S&P 500. And so we're turning a blind eye. I don't know if there is reasons why they're doing this, but you can see the market share between just the S&P 500, the large growth companies, is not even. You can see that Apple, Microsoft, NVIDIA have the large share of that. And so what we want to be careful of is everyone's pointing to that the market is positive this year, but it is not spread across all sectors, and it's not spread across all capitalization or size of companies. So again, something we're keeping a close eye on, because that can shift when you have so much concentration into these small companies. If they start to have a bad day, the whole market starts to have a bad day, the whole S&P 500. And you've heard me say this in reviews and in visits, that the S&P 500 is a great benchmark, but it's not perfect. The S&P 500 is made up of 500 large U.S. companies that is market weighted. So like this, which means it's not as diversified as everyone thinks it is. But again, what do investors want? What the media pundits tell us to want is we need to beat the S&P 500. We need to make as much return as the S&P 500. The other thing we don't want to turn a blind eye to is international stocks. What this graph shows you is that right now international equities are selling at a discount compared to domestic equities, compared to the United States. And we've known for a while now that international has been a laggard. It's really slow compared to the United States, and that's where Warren Buffett says his famous words, "Don't bet against the United States," and he's right. However, it comes to a point where, and I'm going to show you some models that Vanguard and other people have projected, that international could have some really good years ahead while the U.S. market does start to cool. And some of the reason is because of a weakened U.S. dollar potentially. It could be because of this discount in what we call price-to-earnings ratio. Basically, price-to-earnings ratio is how much a company is selling for compared to its earnings, and as well as the dividends. I mean, international companies are paying really good dividends. So that's why you'll see some international exposure in your portfolios. You've seen the emails we've sent to you that we've asked you for a copy of your 401k, a copy of your TSP if you're still working, so we can tweak those allocations and make sure that you have not neglected the iFund or some international exposure. One of these days, I'm going to go in the same direction. Up is down, so I got to get that figured out. What is driving market performance? I want to zoom in to these indicators. If we were to pick up the hood of the economy, these are the pistons. These are what's driving the market. And you've seen these indicators before if you've went to one of our State of the Markets or halftime reports. Green is usually good. The problem is, as you can see, there is no green. There's a lot of red and a lot of yellow. Now, it does look very bleak, but that is a sign that we potentially are bottoming out and we're turning the corner. We are keeping a close eye on profit margins of companies, corporate earnings, but there is some good news that I'm going to talk about, but we equally on one side don't want to rush in there, and it doesn't usually pay to be a pioneer. That's how you get some arrows in your back. So we're just careful, and we're being a little cautious, but we are optimistic. If you've been listening to the monthly market recaps, I've told you that we are turning our outlook to being positive. And here's why. This rebound in profit margins. What this is showing you is the profit margin for the large U.S. companies and how much money they're making on every dollar of sale. And this is really encouraging. And you can see during these shaded areas what the recessions that we've experienced or the down cycles that we've had, consecutive quarters that were down, how it affected profit margins. But profit margins are looking really good. And that's because companies are utilizing technological advances. And again, you've heard me talk about this on the monthly market recap. They're also operating with really good best practices. And so we love to see this because at the end of the day, what pushes the market forward, the underlying fundamental that pushes markets forward, and the market has to ideally be higher 10 years from now, is because of efficiencies, because of innovation. And so innovation is never sleeping. As negative as people want to be, the human race is very resilient, and we will come up with more innovations. And that's what encourages me, And I love to see this optimistic slide right there. Now, if we were to talk about the word recession, that recession word has been thrown out so much over the last 24 months. The back of the envelope definition of a recession is 2 consecutive negative quarters. Yet, if you were to ask the Bureau of Research of Economics, NBER, however they like to be referred to, they are the unofficial scorekeeper of if we're in a recession or not. And these are the 6 indicators that they determine if we're in a recession. And as you can see, 4 out of the 6 are positive. There are 2 that are negative, again, that we keep a close eye on, but these are the economic indicators that determine if we're in a recession. Now you might be thinking, well, it sure feels like we're in a recession. Well, if we tighten monetary policy, which is what the Fed is doing, if we have outrageous inflation for the last 24 months, no wonder it feels like we're in a recession. But at the end of the day, these are the fundamentals that we look at and determine if we're officially in a recession. Now, this is probably the most startling, and this is the one that gives me the most pause. The most concerning slide I'll probably share with you tonight is this one. This shows our spending as consumers. When helicopter money is thrown out in a COVID-like scenario and government intervention comes in to slap the invisible hand of capitalistic markets, this is what we get. We get trying to play God with the markets, and what happens is consumers get scared. They get money that they're not used to, which when people get windfalls that they're not used to, they do frivolous and sadly stupid things. So what happens is we saw a lot of people start saving money, and I told you at previous reports that this is not long-term savings changes, and long-term saving behavior has not changed. And you're seeing it right here. We saw $2 trillion of savings in less than, 2 years evaporate. And now we're seeing credit cards for the average consumer starting to escalate. And when people get in a rhythm of spending more than they make, it is very hard for them to slow down. So this is something we do want to keep an eye on. Now, this makes me take a deep breath. The Fed has been trying to manipulate markets, and they've been doing it with good intentions, at least. They're trying to get inflation to slow down. And we've seen 9% inflation last year come swooping down to 4% inflation today. So this is very encouraging. Now, we've seen energy and food costs start to come down, probably because everyone's got their own chickens now. I have my own chickens in the backyard. So it's nice when you don't have to be so dependent on Publix for your egg prices. And we've seen some of those costs come down. What we have not seen is shelter come down. We've seen shelter start to stabilize, but it is still causing inflation. Now, here's the problem that we talked about at previous reports is that they kept on talking about this transitory inflation, and that inflation is, we're trying to get it down to a relative levels. Inflation is not good. The Fed has said that they're okay with 2 to 3% inflation. It is not good. It is not something we want to have at all. I mean, who wants their money to decrease at any amount by standing still? So they've settled for this 2 to 3 benchmark, and we've seen it go from 9% to 4%. But just because inflation has slowed down, it's not that prices have come down. It's that increases in prices have come down. And so the aftermath of inflation, again, has taken its toll on the average consumer. And sadly, that's what's happening to your grandkids and your kids because they're consumers. And what we're trying to educate the younger generations, and I encourage you, it starts at the dinner table, it starts at the family level, is educating your children and grandchildren to not be consumers. To be employees is the best next step, but the next thing and the best thing to be is an owner. And that's why it's so important to lower that spending and invest into equities, invest into real estate, so you're no longer one of those consumers that they pass inflation onto, but one of the owners. And so we need that education to happen at the dinner table because it's not happening at the desk table in school all the time. Another very encouraging thing that I've talked about again on monthly market recaps is the technology we're seeing. AC jobs are in trouble. And I have one of those AC jobs. AC jobs, Terminator is coming after all those AC really nice jobs. Now, building, construction, extraction, as you can see at the bottom of this chart, are safe. So far, we don't have robots with AI, doing the roadways, which would be really nice on 9 Mile, by the way. We could utilize that. But you can see that the legal field, office and administration, are going to see rapid automation. I know many of you have probably played around with tools, AI tools like ChatGPT, and they are going to change the world. They will. However, the market has already assumed that AI has changed the world. Now, this is oddly familiar, and it feels like an echo of the dot-com crash to me, how that we said the internet's going to change the world. And in 2000, at pets.com, they thought the same thing, and it didn't. But things happen, internet gets faster, we don't have this annoying dial-up, and then now people are using Chewy.com for their pet supplies, and we say, yes, internet has changed the world. AI will do the same thing. Drone technology, 3D printing, those 3 major technological advances are going to change. It's going to look like magic over the next 10 to 20 years. But unfortunately, the market thinks it's already happened. And I think they're going to have a letdown when this AI hype starts to cool down, because it's very exciting. We're starting to integrate that even at SWAN Capital with, utilizing to organize files and things like that. But at the end of the day, it takes so much human input still. But where are we headed? I think that's what we all want to know. So let's jump right in. This is a slide I love to always put in here. These are the greatest financial minds. They're paid very high 6-figure plus incomes in New York City, probably even paid more than that, and they come out with these estimates of where the market's supposed to end. And there's a lot of group think in here, right? They don't want to be way out, the outlier, and then laughed at by their peers. So they all say, hey, what do you think we're going to say? Well, I think we're going to go with this number. And guess what? The analysts, the media pundits, the fearmongers, wrong. They thought that the S&P 500 was going to end flat. And so far, the market's at, 4,500? Way off base. So it just proves to me, and you've heard me say this very brash statement, that most people have no idea what the future holds, and they have no idea what they're talking about. But isn't it funny that people that have no clue what they're talking about are so passionate, aren't they? And I've seen a lot of that lately. People just giving free financial advice that the market is going to end flat. And so far, it's not looking that way. So some of the things that we're estimating and assuming is that we do see inflation starting to cool. I don't think we'll be in a deflationary environment, which I personally think would be good. A lot of economists would love to argue that. The Fed interest rates will start to cool down. That's already started to happen, and I would love to see them stop in 2024. Now, my personal opinion is that the Fed is not going to lower interest rates. So many people, especially mortgage brokers, would love to say, we're going back to those lower interest rates. We should have never been at those lower interest rates. If you think about it, 5 to 6%, you remember buying mortgages in the 70s and 80s, it could be a lot worse. The problem is they're trying to buy the same house. Your grandkids and your kids are trying to buy the same size house you have, or 32% bigger than what you grew up in. And that's the issue, is they don't want to look frugal. That's not in vogue. I don't know if it ever has been, but they definitely don't want to buy a smaller home. And they definitely don't want to stop with all of these outlandish vacations and having things delivered, having their food delivered instead of making it themselves. So we're also hoping that after the Fed stops raising interest rates, we'll hope that the labor situation stabilizes, and I'm going to talk about that in depth. So this is the forecast that I want to break out for you. One thing that we talked about international equities earlier is looking at international equities having a really nice decade ahead. This is taken from Vanguard's quantitative model. Again, just a forecast, but they're assuming that international equities will have a strong decade ahead. Again, we're not going to bet against the United States. No way. But we are going to have that small exposure to international equities because, as you can see in this graph, there's a lot of reason and a lot of support for it to happen. The lower job openings, this is from the JOLT survey that looks at what job openings are available. This is a very encouraging slide. As you can see, we had historic job openings that have come down a little bit. But usually when we run into a black swan event, a very deep recession that maybe we didn't expect, we're out of jobs and we're letting people go, and people want a job, but they can't get a job. And that makes the recession just that much worse and that much more painful. Luckily, we have a buffer of jobs that are still available. Now, what's going to happen? Innovation will fill this gap. If we don't have the educated workforce or enough people because of birth rates to fill that gap, innovation is going to happen, and AI tools and robotics will have to take that gap down over time because companies need to fill this position, or they'll use technology to fill it. But this is a very comforting slide because it tells us that we have a buffer in the job market. Now this will make me get on my podium. This shows the dichotomy of government spending versus government financing and where we're getting our income that we're spending. Right now we're spending, I believe Lucas can correct me, but I believe we're spending 23 to 26% more than we make. Let me give that easy for you to how I like to think about it. A $100,000 household, imagine that they're spending $126,000 every year. They're already in debt to their eyeballs. They've already raised the credit card limit, and they're looking at each other and saying, something's got to change, but it's not our spending. This is the dilemma we're in. And you can see that not only are we spending more than we have, we're having to go finance that quarter of a difference. And it's a real problem. The other thing that I'll get off my podium in just a second, but look at how we're spending the money. If you see healthcare, which we're supposed to have the greatest healthcare because we're spending the most on it, yet we potentially don't based on many surveys. And then look at Social Security that we're spending money on, but we're running soon to be deficits in the next 6 to 7 years on that. I would say those are important. Healthcare, retirement income. Look at this, 14% defense spending. I know this is controversial, but that's a lot of the budget for, I don't know, agriculture, education, everything else, VA benefits, all of this represents what's left. We have a problem, and that I think, sadly, our elected officials can't get it straight. So something's got to change there. And I'm going to talk about what that has to do with your personal economy, because we can gripe about politics, and we can gripe about the economy, and I'm right there with you. But at the end of the day, the only thing I can change is Andrew McNair's personal economy. And you should think that exact same way. What can I do to stay 3 steps ahead of the government? What can I do to stay 3 steps ahead of the economy? And so I'm going to talk to you about the strategies that we're implementing here at SWAN Capital and have been for the last year. The first thing is Roth conversions. So after I've got down off my podium about government spending that's out of control and is not in balance, they're going to eventually turn and say, we need to start making some more income. If we have $100,000 of income, we need to raise that income. Well, just by printing more income doesn't give them more income, right? They're going to look to the people like us, you, to pay the tab. And so I don't want that target on my back. So that's why we encourage our clients like yourself to have an extreme amount of tax-free retirement assets going into retirement. And so one of the things that we've been doing is this migration from qualified accounts and taxable accounts to more tax-advantaged accounts like non-qualified accounts, accounts that have capital gains, and ideally tax-free investments. And again, there are 5 tax-free investments: Roth IRAs, Roth 401ks, HSAs, life insurance, municipal bonds. And we want to be maximizing them because the sale is coming to an end. In 2025, it is a very easy political stance to say, I'm not raising taxes, I'm just letting them go back to what they were in 2015, which was more. So again, you know that we've been doing this with you one-on-one with Roth conversions and other tax strategies, and we must continue for the next 2 years. It is painful. It's like taking your medicine, and it is not fun to be me telling you to take your medicine, but we need to pay the taxes because eventually government spending is going to mean we need more government financing. The other thing that we've been active is rebalancing. And rebalancing has so many advantages. I mean, it's one of the free lunches in finance. The first thing that it does is it gets your risk tolerance back to equilibrium. If we have some winners that keep on winning, it's like continuing to step up on a taller and taller ladder. Yes, it's really fun to have a good perspective and see higher and see farther, but at the end of the day, it becomes that much more dangerous. So we have to start selling winners and buy some of those losers because those losers do turn into winners. The other thing we need to do is make sure that we're not underweight and overweight in any certain position. And as you can see, in quarter one and quarter two, we were a little bit heavier in between value and growth, and we shifted into growth. Why? Because growth was being picked on last year, and it had a really tough year. And so we got out of value and started stepping towards more growth. Obviously, that's paid off because growth has had a good year. But now we're starting to go back into value because we want to keep that equilibrium between value. Some of the other changes that we made is we switched from shorter term bonds to intermediate bonds. Why? Because we wanted higher yields, and we do think the Fed is coming to an end of interest rate hikes. So we're changing our positions. We're changing overweight and underweight. We're getting your risk tolerance back to where it belongs. You probably saw the email that we sent to you asking for your 401k, asking for your TSP if you're still working, so we can make those changes to your allocations. If you didn't get the email, be sure to send an email to Lucas or Evan, and they'll be happy to help you and talk through those changes. The other item that we did is we changed from emerging markets, VWO, to VYMI, which is the Vanguard International Dividend. And we made that slight pivot, still from international to international, because we want to make sure we're in international companies that have a history of paying dividends. I can tell you there's probably going to be more changes to come. The market will not stand still, and we will make these rebalancing changes on your behalf inside our SWAN portfolios. But as you can see, we've been busy, and you want us to be busy working behind the scenes to make sure that we rebalance. The other thing that we've been doing is tactical investing. And this is the secret sauce. Everything in our emotion, everything in our heart when the market is looking ugly and bad like it was in 2020, like it was down 19% last year, you heard me say we want to run into the storm. Why? I love this analogy. When the storm comes in, which we know all too well because it's raining tonight, is that when that storm comes off the prairie, buffaloes decide to run into the storm, knowing full well that the storm can't last forever, and they know that they'll be less wet if they run directly into it. But cows, because they're slow, decide to run away from the storm only to get that much more wet. So this 4-speed transmission, the 4 portfolios that we manage on your behalf, we made the decision, very scary, brave decision, to actually move from second gear to third gear, to move from third gear to fourth gear. And it is not fun to go through when the market drops farther and farther. Now, there will come a time if the market continues to heat up and the Shiller PE ratio goes 32 to 35 to 37. Right now, it's roughly around 32. We may start downshifting your portfolio. This is where tactical investing pays off. Whenever we can sell bonds to buy more equities, long term, that will pay off. Now, note, that little neutral might be there, but it's just to signify that there is no neutral. Many of you may say when the market has a black swan event, and I assure you, we will have another black swan event. We will have another market downturn. There is no neutral in this transmission, because when you go to neutral, you have to be right twice. You have to time when to get out of the market and when to get back in. And we know from too many statistics that that is a bad idea. The other thing we've been working on with clients is because of the interest rate hikes that have happened, we have had more opportunities. Like right now, we have a money market, for example, at 4.9%. And we have opportunities in CD alternatives that can make you more interest. And so if you want to talk about those options to increase your interest that's available, please do get with the team. I know Evan's been reaching out to many of you because some of your wall accounts have free withdrawals that are available and opportunities to switch to a higher money market. That is a good idea. So you'll be hearing from us over the next few months about doing that. We'll be talking about that in reviews. The next thing is dividend reinvestments. Many of you are relying on the income from your investments. A lot of you are actually not, though. So I want to show you that dividend reinvestment pays off. When you're dollar cost averaging and you're taking those dividends that you're not utilizing, and we're allowing that to continue to buy more shares in a period like 2022, in a period like 2020, that pays off huge dividends, pardon the pun. It will help in the long run. The other thing that we've been doing is from your wall accounts, if you remember the analogy of the fiscal house, is we've been taking 10% maneuvers from the walls to the roof accounts so that we can buy more equities. And again, that has not played itself out, but it will pay off in the long run. We've spoke about Signet in previous reports. This is not right for everyone. You have to be an accredited investor with over $1 million net worth, $1.1 million net worth, or you have to be a qualified client with over $2 million in assets. But we've also spoke to many of you about Signet and increasing alternatives a part of your portfolio. This is a very handy diagram, and I want to explain it. As you can see, the return is on the left side of the x-axis, and the y-axis shows you volatility. On the very far circle over here, you can see that if you have 80% in equities and 20% in bonds, you're going to have great returns, but man, you're going to feel the bumpy ride that's ahead in the market. Now, you could go with the 60-40 portfolio, which is right here, a 60-40. Again, lower return, lower volatility. That's what a lot of people preach. A lot of financial advisors. As you know, we do not prefer a bond-heavy portfolio. We like to use bond alternatives, and we like to use actual alternatives. As you can see here, this is a very good mix of 30% alternatives, 40% bonds, 30% equities, very high return, low volatility. And again, I really like this one that has the highest rate of return, still lower volatility, and that is, again, a higher equity exposure, a little bit of bonds, a little bit of alternatives. So here's the point of this slide. Having real estate, private equity, and hedge funds a part of your portfolio actually can add more diversification, help lower the volatility, and increase the return. So if you've heard us talk about it, you got a webinar about Signet, definitely reach out to Evan or myself to talk about it more. Here are some action items for you and things that you can do to help your personal economy. Going full circle. Again, we can't control the economy. We can't control politicians or the market, but we can control our personal economy. The first thing is we need to make sure that you keep us up to date with important life changes. This is probably your go-go years, the time where you don't need to put retirement on pause. If you need more income to go enjoy the vacation, to go see grandkids, you need to be doing it now. And this is a great time while the market's up to take money out of the market and go do those things and make the memories now while you have the health and time and freedom to do it. So if you need help with that, give the office a call. Next, inform us if income changes. I already talked about that. Roth conversions. We're already doing that one-on-one in reviews. If we haven't done that Roth conversion, we need to make sure that we discuss that before December 31st of this year. Also, if you're working a part-time job, so many times people don't tell me that they've made $3,000 working Uber, doing some rides at night. Well, that's cool that you're driving Uber, but you can take that $3,000 of earned income and put that $3,000 into your Roth IRA. As long as you have earned income, you can go up to your earned income as a Roth contribution. Give you a very easy example. If we have a client that has part-time income of $15,000 and them and their spouse can put up to $7,500 into a Roth IRA, they can take their income from a taxable account, a money market, and put that in a Roth IRA where it grows tax-free all the interest, which is pretty cool. Again, send us your 401k allocations if you haven't. I've already said that. If you need to get with Rhonda about filing your taxes, if you haven't, you're running out of time with October. I do want to talk about the Secure Act really quickly. The Secure Act 2.0. There are changes coming down the pipeline, and I want to just highlight two of them. RMD changes are happening. The RMD age is changing, as you can see in the very fine print, that if you reach age 72 after 2022, your new RMD age is 73. If you reach way out there, some of you are very young and you will take advantage of that. In 2032, it'll be like 75. So as you can see, RMD age is pushing up. It's very interesting that the IRS and Congress has decided to do that. Next, I do want to talk about this. This is a great opportunity for your children as a grandparent to put money into a 529 plan. They're going to allow you to actually move that to a Roth IRA if you put money in a 529 plan over to a Roth IRA if that child does not use it for college expenses. And there's a limit. You can only do $35,000 lifetime limit, but I think that's a really cool change that the Secure Act allowed. If you have questions about your legal documents and you or maybe you had your legal documents paid for by Scott and haven't done them. That recently just happened. I had a client that said they paid 2 years ago, but still haven't met with Scott to do them. If you pay for them, but you haven't signed them, they're still not done. So get in there with Scott to make sure your legal documents represent your wishes, because we want to make sure that you have up-to-date documents. If you have documents done by another attorney, but you would like a review, that's a complimentary visit, a complimentary review that's available to our clients. So I think that's really nice that Scott does that. A lot of questions about this. Is this a good change? Absolutely it is. Schwab has a very good reputation. Fidelity, Schwab, Vanguard, some of the biggest custodians in the world. Schwab bought them like 3 years ago. When you have trillions of dollars that are merging, of course, it takes a lot of time to get that merge to happen. I want to tell you that you don't have to make a lot of changes. You're going to have an account change. You're going to see your account numbers change. But if you've already signed up at advisorclient.com and you have your login already done, I am being told that it should transition automatically and you will not have to do new logins. You will be told about your new account numbers. Everything should be seamless. So I'm told. Thank you so much for the trust you put into us. Have a wonderful evening.